Let's have a look at one of the example on finding out what is the net working capital. Rising Star Inc. is forecasting that their sales will increase by 250,000 next year, 275,000 the following year, and 300,000 in the third year. The company estimates that the additional cash requirement will be 5% of the change in sales. Inventory will increase by 7% of the change in sales. Receivables will increase by 10% of the change in sales, and payable will increase by 8% of the increase in sales. Forecast the increase in net working capital for Rising Star over the next 3 years. So if based on the previous narration, the sales figures are shown here, 250 to 75 and 300,000 in year 1, 2, and 3 respectively. And you have all the components for working capital, which is a cash requirement, inventories, and your receivables. All these are your current asset, and you have your current liability, which so each and every one of these are percentages against a sales figure. So in other words, for cash requirement is basically 5% of sales, so 5% times 250, and then you have 12,500. The same thing for year 2, to 5% times 275,000, you get 13,750, and year 3, which comes 15,000. So you do all the percentages for each one of all the sales. Sometimes you have against sales, sometimes for payables, as we already done previously, is against cost of goods sold. For this example, we use all of them, you use against sales. So once we have all the figures here, what we have to know is that we know that the current asset is minus your current liability. So what you're going to do is that you're going to add cash requirement plus inventory plus receivables, and you minus your payables. So if you were to add all these three minus the 20,000 here, you receive 35,000. So your net working capital is 35,000, 38,500, and 42,000. But if this is for you to be used, what you're going to do is that you have to filter it in the next. If you want to find out what is the changes in net working capital, you find the differences between the current year. You're going to have 35,000 minus year 0, since year 0 is nothing, so you have 35,000 in year 1. For year 2, you have 35,000, so you're going to have around, let's say, 3,500. For year 3, which is 42,000 minus 38,500, so the difference is 3,500. So you're going to have the next line item following the net working capital, which is the changes in the net working capital. So you're going to key in the differences from one year to another. So here what we are going to do is that we are going to figure out the actual impact of depreciation, why we add and then why we minus and then we added it back. So how does it affect in terms of whether you have an increased or you have a decrease in the figures when you were to do both of them. So let's look at how we derive initially. For the free cash flow is basically you have the revenue minus cost minus your depreciation. All these your EBIT. So your EBIT times 1 minus T. So what you have here is that you find what is the unlevered net income, which is a net income after you take into consideration the tax, okay? And then after that, you add back your depreciation, you minus your capital expenditure, and then you minus your changes in the net working capital. And if you were to expand this calculation further, in other words, you take out the depreciation. So depreciation, what it's going to have is that it's going to 1 times the minus depreciation minus the tax rate, you times the minus depreciation, okay? And if you were to look into it, you're going to see what you're going to left over, because here you have 1 minus the depreciation. It is going to add back the depreciation. So the depreciation variable here would just disappear. It would cancel off itself, because here you have minus and then you have plus depreciation. But then if you were to look here, you have minus the tax rate here, minus T, minus the tax rate here, times the minus the depreciation, you have a plus. So here you can see that the result is that you have the tax rate here times the depreciation. So the term here, the tax rate times the depreciation, we call the depreciation tax shield. So basically what it says is that by minusing the depreciation from the expense, and it lowers the pre-tax income, and then you minus the tax, and then you add back the full amount of depreciation. After that, the impact of it is that you have an increase in the amount by depreciation times the tax rate, and we call it the depreciation tax shield. Let's figure out the NPV, okay? The numbers that we are going to use here is based on the table in example 8.2, which is the cannibalization effect. As we know that the free cash flow there is for the first year is minus 6,000. For the 0 year, we have a minus 6,500 or minus 6.5 million. And then for year 1 is 5,100, year 2 is 7,200, is the same until year 4, and you have year 5, you have the free cash flow of 2,700. Right now we are trying to discount it, okay, at 12%. So so we have to discount it at 12%, which is the weighted average cost of capital, and which is here, which is weighted average cost of capital, which is 12%. And if you were to NPV it, and we would the result which shows the NPV at 5,027 or 5.027 million. So so those are the numbers that we get here. So this is the same figure as what we have over here. And here what it's using is that it's using the table form. So it takes all the factors and then it simply times it up. So what we're going to do is that we are going to use our financial calculator. So here we have our financial calculator. So the first thing what you have to do is that you have to reset it, the compounding. So you have 1 orange and PYR, and then you were to check it again, orange and clear all, and so you have P over YR. So just to remind you, and then what we're going to do is that we are going to key in the numbers for the year 1, for year 0, 6,500, and so on and so forth. So what we have here is that we're going to key in which is 16500, and then you have to minus it, and then we press your CFJ. So that one is for year 1. So we do the same for year 2. For year 1, okay, just now was year 0. So for year 1 is 5,100 CFJ. For year 2, year 4 is we have 7,200 CFJ. or what we can do is that we can either repeat it another 2 more times, since or we can tell that it is going to be 3 times the same repetition. So what we're going to do is that we press 3 orange and J, so that will tell that is going to be the same figure for year 2 and year 4, 3 and J. And the last one, we just key in 2,700 to 700. So you have there, then you press your CFJ, and then the last one you press your interest rate, which is 12%, 12I, and then you press orange NPV, orange and NPV. So you have the same figure, 5027. So that's one of the ways how to do that. But if you've not feeling, you just like to recheck it again and uses not the NJ function, you just wanted to repeat the 7,200 3 times, you can do that. Let's say, let's do again, orange and clear it all. So you press 16,500, which is for the year 0. You indicate the minus sign here, then CFJ. So because that is your initial investment, where you invest $6,500, and that is a cash outflow. So you press CFJ. Then you have 5,100. Then CFJ. So that is for year 1, and from year 2 to year 4, you repeat the same figure again. So you have 7,200. CFJ, and then 7,200 CFJ, that's year 3, and then another one, 7,200 CFJ. So that's year until year 4, and the last year you key in 2,700 CFJ, and then don't forget to key in the interest rate. The interest rate is around 12%, so you have 12%, and then you press orange and NPV. Okay, again, not so sure why the figures are wrong. Okay, let me go again, orange and clear. You have 16,500 orange, the minus factor, then you have CFJ, so that is year 0. And then you have 5,100 CFJ. Then you have 7,200 CFJ. That is year 2, 7,200 year 3, and then 7,200 year 4, and 2,700 year 5. Okay, and then you press 12%, 12I, then you press orange and NPV. So you get the 5025, close to it. Okay, so I did something wrong just now, but that's the. Let's figure out the NPV. Let's look at other alternatives. What are other ways in order to produce HomeNet is, okay, here what we are going to look is that whether to look at 2 alternatives, whether the original one to outsource it, or what Linksys can do is that they can manufacture in-house. So which one is much better? Which one is much cost saving? So in this example here is evaluating manufacturing alternatives. In the HomeNet example, assume the company could produce each unit in-house for $95 if it spends $5 million upfront to change the assembly facility versus $110 per unit if outsourced. The in-house manufacturing method would also require an additional investment in inventory equals to 1 month's worth of production. So here what we're going to see is that we know that originally it cost $110 for outsourcing. And if we were to think about, if Linksys were to think about to produce in-house, the costing will only cost lesser than that, which is $95 per unit, but you have additional upfront cost or fixed cost of 5 million to change the assembly facility. And also we need Linksys have to make additional investment in inventory, which is equals to 1 month worth of production. So we like to figure out which of these alternative is better. Let's look at the first alternative in detail, which is the outsourcing, which is the original one. The cost per unit is $110. And in addition, the investment in accounts payable, there's in which the company owes to the suppliers, which is basically 15% of cost of goods sold. So in other words, if you have the cost of goods sold is 100,000, so the way how we're going to calculate is 100,000 times $110 per unit. So you have for that year is 11 million. So for that year, let's say it's year one. So if our investment in accounts payable is 15%, so if 15% times 11 million is 1.65 million. So if you were to again look at the changes in the net working capital, we will see that it is minus 1.65 million here, because we are looking at the changes year one but minus year zero. So you have minus 165 million, and we are going to recover in year 5 1.65 million. So in other words, net working capital falls since this AP is financed by the suppliers. So we are going to look in detail in the next using Excel spreadsheet in the next slide. So if you were to show in our Excel spreadsheet, so the scenario is outsourced production, and here is where we can see the changes, how we derive all those figures. You have units produced and the cost per unit. So year zero is irrelevant because we outsource it, we are not investing it. So what we are looking is that let's say, because this one we've already figured out, okay, this one year zero is irrelevant. We are looking at outsourcing for year 1 to year 5, because either we outsource it or we manufacture it in-house. For year zero, all our initial investment are the same, whether we are talking about alternative 1 or alternative 2. So since it's the same, it is irrelevant cost for us to consider. So we're only thinking about year 1 to year 5. So for the units produced, we have 100,000 here, and the cost per unit is 110. And for the EBIT, we have basically 100 times 110, you have 11 million. And then you derive your income tax, which is at 40%, and your unlevered net income is minus 11,000 minus 14,400. So we have actually a lesser minus there, which is minus 6,600. So your accounts payable here is basically as a result of the amount here. So you have year zero 15% times these two, or you can just say 50% against 11 million, so you get 1,650. So here what we've already figured out based on the previous slide, since we are just looking at the changes. So the changes here, as we know, if you were to find what is the working capital itself, we will have 16,500, 16,500, 16,500, 16,500, and 0 here. But here, since we are looking at the changes here, so the changes is that we take the 16,500 minus 0 here, so we get we got 16,500. So here what is indicating is that the changes here, since net working capital, you minus it, I've already put it as it is already a minus. So in the year one is going to be, in year two is going to be 0, because in other words, since we have both years, year two and year one is 16,500, 6,500, so it's going to cancel off. So you're going to have 0, 0, 0. And year five, because you have 0 minus 16,500, 0 minus 16,500, 1,650, so you have a minus 1,650. But then actually the minus in your accounts payable here is actually a positive. If you have a minus figure here, it's actually a positive. So in other words, if you were to look at the free cash flow here, what you have is that 6,600 minus okay, 1,650, you have 4,950. Here, what you have here is you have 1,650. So in other words, you have 0 minus 1,650. You have minus 1,650. For the alternative 2, which the Linksys thought of manufacturing in-house, the cost per unit is lesser, which is $95 instead of $110. There will be upfront costs in setting up the assembly line, which is $5 million. And also there's an investment in accounts payable, which is 15% of the cost of goods sold. So in other words, in this Excel spreadsheet, it will show the cost of goods sold is 100,000 times $95, which is 9.5 million, because the cost to cost per unit, okay, to manufacture each unit of the reboot, which is $95. So everything is 9.5 million. And for the investment in accounts payable is 15% of the cost of goods sold, which is of the $9.5 million. So you have 1.425 million. And as far as the investment inventory is basically 1 month of the cost of goods sold, which is in other words, if this is yearly basis, so in order to figure out the 1 month, you have to divide by 12, so you have 0.792. So for each year, for the net working capital is basically you have the current asset minus your current liability. Your current asset is the inventory, which is 0.792 million here, minus your current liability, which is the payables, which is the numbers you derive here, which is 1.425 million. So you have 0.633 million. So you would have reflected here in year one as absolute figure as 0.633 million. So the net working capital will fall by 0.63 million in year one and increase by 0.63 million in year 5. So if you were to look at the changes here, the changes, it will be an increase in the net working capital by 0.63 million. But since it is a minus, so you just have to it being expressed here as a minus 0.633 million. So we'll look in more detail in our Excel spreadsheet next. Let's look at the net working capital effect on the alternative 2. So we know that the unit produced here is 100,000 per year, and then the cost here is $95 per unit. Okay, since we don't figure out what is the sales, so our EBIT is reflection of the actual cost here. So what we have here is the numbers here is derived from 100,000 times $95 per unit. So we have basically the actual EBIT is simply the cost itself, which is reflected as a minus, which is minus 9.5 million. So you have every one of them is minus 9.5 million, and then you have your income tax, which is 40%, and then your unlevered net income is all these amounts here. But at the same time, we already noticed that we have to invest upfront cost of 5 million, and as a result that the income tax will be around at 40%, the unlevered net income is around 3 million. Okay, as far as the working capital is concerned, okay, increase in net working capital, basically this one is based on the cost of goods sold. So it's 1/12 of the cost of goods sold here. Okay, so it's 100 times 95 divided by 12. And then for the accounts payable here is 15% times this cost of goods sold, which is unit produced and cost per unit. So the increase in net working capital is current asset minus your current liability. So you have if you minus these two, you have somewhere around minus 633. So as a result of your free cash flow here is basically your 5,700 minus the differences between these two, which is minus 63. So you get minus 5700 minus, and since this is minus, so you get minus 633. So you have plus 633 in essence. So the free cash flow here is minus 5067. So here, since you're looking at the net changes here, so there's 000 here, and then on the 5th year you're going to reverse it, the numbers again, you're going to recover it again. So so this is the reflection of the free cash flow for alternative 2. If we were to compare the changes on the effect of alternative 1 and alternative 2, okay, for alternative 1, based on outsourced assembly, you find out the free cash flow is all these numbers here. And then if you were to find the NPV here, is that we get a minus 19,510, or specifically 19.510 million. For the in-house assembly, these are the free cash flows we gotten, and then when we NPV it, we have the minus 20.107 million. So given these two numbers, which alternative is better, whether you have minus 19.5 million or minus 20.107? So based on understanding here, the numbers here is much bigger, even though it's negative, but relatively is much bigger for alternative 1, minus 90 million versus minus 20 million. So the decision is to go with outsourced assembly. So we look in the Excel spreadsheet next. Let's have a look at the Excel spreadsheet. So for the Excel spreadsheet, what we have is that we have the unlevered net income amount is here, and then we have your accounts payable. Basically, this is 15% of the cost of goods sold. So basically, your cost of goods sold is basically this amount here. Sorry, the cost of goods sold is basically 0.5 times E6 plus E7 is derived from 15% times these two figures here. So you have 1,650. So as a result, your unlevered net income here is your unlevered net income here, your free cash flows here is basically 4950, which is a result of minus 6,600 minus 1650. So you have 4950. And then if you were to do your NPV here, your NPV here is you NPV it at 12%. So you have 19,500 minus 19,510. So if you were to look at alternative 2, you have the unlevered net income, all this amount here, which are more or less the result of you're using your cost per unit at $95. So these are the real figures. And also here we have to take note is that for year 0, we have an upfront investment of minus 5 million. The income tax that is levied against it is around 2 million, so you have unlevered income of 2 million here. For the inventories, for the net working capital here, basically for the inventories is 12%, as we already figured out. Is 1 month of the cost of goods sold. So this amount here, we times it divided by 12, so we have 792. And the accounts payable here is the same, is basically 15% out of that of the cost of goods sold, so you have 1492. So what we're going to do is that the free cash flows here is basically unlevered net income minus the differences between these two, 792 minus 1425. So we have around a minus I think 633 something, and then from that minus 633 we take minus 5700 minus 633, so we have minus 5067. So if you were to do the NPV here, our NPV would show at 12% and 12%, and then we CFG all these things, and then we and then we find out what is given. Our initial investment is around 3 million. So based on that, our NPV is around 2107. So you can check it out here also in the calculator. So if you were to use the calculator to figure out all this amount, the NPV, let's do it again here. So our CFJ here is minus 3,000 for year 0. So we have 3,000 minus CFJ year 0, and then for year 1 is minus 5067, so it's 5067 is year 1, and then for the year 2 is 5700 minus again here, then you have CFJ, and then you get the same figure appears another 2 times. So we have to put 3, okay, 3 times here. You get 3, which is included the year 2 also. So you get 3 orange and J, and then for the last one we put 633 minus orange and minus, then we put the CFJ here, and then the weightage average cost of capital is 12%, 12I, and then we press orange and NPV, so you get the same figure, 20 minus 2106.89. so it is the figure that we reflected here. So in other words, sorry about that, accidentally pressed it. Let me see. Is minus 3,000 for year 0. So we have 3,000 minus CFJ year 0, and then for year 1 is minus 5067, so it's 5067 is year 1, and then for the year 2 is 5700 minus again here, then you have CFJ, and then you get the same figure appears another 2 times. So we have to put 3, okay, 3 times here. You get 3, which is included the year 2 also. So you get 3 orange and J, and then for the last one we put 633 minus orange and minus, then you put the CFJ here, and then the weightage average cost of capital is 12%, 12I, and then we press orange and NPV, so you get the same figure, 20 minus 2106.89. 0.89. So it is the figure that we reflected here. So in other words, we would choose alternative 1, which is minus 19 million, versus the alternative 2, which is minus 20 million. Okay, let's comparing free cash flow of Cisco alternative and outsourcing. Is so what we find is that outsourcing is the least expensive alternative. Okay, let's look at another example here. Let's look at another situation. Example 8.6. Suppose that in addition to the $7.5 million in new equipment required for HomeNet, which is basically the server, some equipment will be transferred to the lab from another Link6 facility. This equipment has a resale value of 2.2 million and a book value of 1 million. If the equipment is kept rather than sold, its remaining book value can be depreciated next year. When the lab is shut down in year 5, the equipment will have a salvage value of around 500,000. What adjustment must be made to HomeNet's free cash flow in this case? So in this case, what it is saying is that it has a resale value of 2 million. That means if we were to sell the equipment that is being transferred from another Link6 facility, and if you were to resell it immediately, we will sell it at $2 million, but still it has a book value of $1 million, what is being reflected in the balance sheet. And also, if you, instead of selling it immediately, if you were to keep it and sold it at the 5th year, it will have a salvage value of 800,000. We need to say it has a resale value of 800,000. So here what we are seeing is that new equipment added with $2 million and a book value of $1 million. So firstly, we have to understand how you are going to calculate the effect if we were to sell it immediately. How much actually the amount that is being realized if the company were to receive that $2 million equipment and they were to sell it off immediately. So first thing is that we have to figure out what is the book value of that equipment. The book value here is basically in its original formula is original purchasing price minus the accumulated depreciation. These numbers should be shown in the balance sheet. So here the amount that is given is already $1 million. And then if the company HomeNet Link6 were to sell it, Link6 were to sell the equipment immediately, okay, how much the capital gain it is. The capital gain is to figure out how much is by selling it, okay, how much is the selling price is over and above its book value. So the capital gain is being calculated by sales price, the selling price if they were to sell right now, minus the book value, which is the selling price is 2 million minus 1 million, it is 1 million. So you have a capital gain. So what we found out is that if the company were to realize any capital gain or basically is a profit, it has to be taxed. So the tax rate here is the tax times the capital gain, which is basically 1 million times, if the tax rate is 40%, you have 40% times 1 million, which is 600,000, which is 400,000. So even if the company were to sell it at $2 million, it has to pay tax around 400,000. So in other words, after tax cash flow is basically the sales price, which is 2 million minus the tax on the capital gain, which is $1.6 million. So that is the $1.6 million you have to build into the free cash flow, in which we'll show in later on. Let's look at the entire solution here. As we read it, the existing equipment could have been sold for $2 million. The after-tax proceeds from these sales are an opportunity cost of using the equipment in the HopeNet lab. Thus, we reduce the HopeNet's free cash flow in year 0 by the sale price less any taxes that would have owed had the sale occurred, which is 2 million minus 40% times 2 million minus 1 million, which is 1.6 million. So just now we already come up with a formula, which is the sale price, the selling price 2 million, and we have to minus the tax rate that is imposed on the capital gain. Here is the capital gain. So there is a 400,000 tax on the capital gain, so we only receive 1.6 million. So in the year 1, the remaining 1 million value of the equipment will be depreciated, creating a depreciation of 40% times 1 million, which is 400,000. So here the 1.6 million is a reflection of a amount that if the company were to decide to sell it off. Okay, so since here we are making comparison between selling off or keeping the equipment until the 5th year. Okay, so since we are making comparison, the 1.6 million, we put it as a minus figure. So for the depreciation on the tax shield, because the equipment has 1 more million of salvage value loss in 1 year, so if we were to take into the consideration of fact, because this is capital items and there is a tax rate on it 40%, so we already known that the tax shield impact, okay, by minusing depreciation, and then we add it back later on, there's a tax shield impact here, so we calculate it as 400,000. And in year 5, the firm will sell the equipment for salvage value of 800,000. Because the equipment will be fully depreciated at that time, the entire amount will be taxable as a capital gain. So the after-tax cash flows from the sale is 800,000 times 1 minus 40%. So here what we are going to find out is the cash flows here is going to be around at the end of 5th year is since it's been subjected to tax, which is 40%, and there's no more book value left, so whatever sale price that is there, it is going to be taxed at 40%, so the company will receive only 60% of the 800,000, which is 480,000. So if you were to recalculate it back in the free cash flow from the cannibalization effect, then you readjusted all these figures here. Here what you did is that 16,500 you minus 1,600, so you get an increase by $1.1 million, and all this depreciation effect here, this one, it increases. Okay, so your NPV here is 4,055. So you can be able to refer, you're able to refer this in the Excel spreadsheet. It will be referred under the incremental, okay, tab. Terminal or continuation value. At times, the project will last forever. Okay, previously we based on the project is going to be 4 years, but if the project is going to be for perpetual or a longer period, we don't really know when it's going to end, or if the company were to go through expansion and it is going to generate free cash flows endlessly, So we would like to know how much is basically the actual value based on the continuation of the project. So so here what we do is that we find what is, we call it the terminal or the continuation value, which is the amount represents the market value of the free cash flows from the projects at all future dates. Continuation value with perpetual growth. That's right, the problem here. Base Hardware is considering opening a set of new retail stores. The free cash flows projection for the new stores are shown below in millions of dollars. For the 0 year, the initial investment is minus $10.5 million. Then for the second year, Base Hardware make a losses of minus 5.5 million. Only then it makes profit. In the second year, 0.8 million. Third year, $1.2 million. And by fourth year, it grew by $1.3 million. After year 4, Base Hardware expects free cash flows from the stores to increase at a rate of 5% per year. If the appropriate cost of capital for this investment is 10%, what continuation value in year 4 captures the value of future free cash flow in year 5 and beyond? What is the NPV of the new stores? Because the future free cash flows beyond year 4 is expected to grow at 5% per year, the continuation value in year 4 of the free cash flow in year 5 and beyond can be calculated as a constant growth perpetuity. So here what we are figuring out is that when we were to figure out what is the future cash flows in perpetuity, or we are looking at the continuation value, we have to know so basically the continuation value in year 4, you have the present value, okay, and then you have the free cash flows, okay, which is in year 4. So what we have to do is, as we know that in the year 4 is 1.3 million, and then after that it continues by 5%. So what we need to know is we need to know what is the free cash flow in year 5. So the free cash flow in year 5 is free cash flow in year 4 times 1 plus G minus R minus G, which R is the interest rate and G is the growth rate. So we have that here. So we get 1.3 million times 1.05, which is the G is 0.05. So you get 1.05 divided by 10% minus the growth rate 5%. So somewhere we got the continuation value in year 4 at $27.3 million. So notice that under the assumption of constant growth, we can compute the continuation value as a multiple of project's final free cash flow. So we can restate the free cash flow of the reinvestment as follows. So basically the 27.3 million occurs at the end of year 4, okay, at the end of year 4. So what we are going to do is that we are just going to present value all the mixture of cash flow that we gotten from all this amount here, and if you were to NPV it, we will get the NPV for it at $5,597,000. So let's look at this part here, which is a tax carry forward. Okay, so tax loss carry forward and carrybacks allows corporation to take losses during its current year and offset them against gain in the nearby years. Let's have a look, an example on the tax loss carry forward. Varian Industries has outstanding tax loss carry forward of $100 million from losses over the past 6 years. If Varian earns $30 million per year in pre-tax income from now on, when will it first pay taxes? If Varian earns an extra $5 million this coming year, in which year will its tax increases?
Okay, let's look based on this question and how the calculation is being made.
Let's look at an example on the tax losses. With a pre-tax income of $30 million per year, as mentioned, been shown here, pre-tax income expected to be received every year for the next 5 years, $30 million for Varian. Varian will be able to use its tax loss carry forwards to avoid paying tax until the year 4. So how do we get that? So the tax carry forward for the $100 million that Varian has to incur, it is able to be offsetted until the 4th year, which is the first year 30 million, so there's left over another 70 million, so we get another 30 million be offset in the second year, third year 30 million, and the leftover in the 4th year is only $10 million to be offsetted. So therefore the taxable income for the 4th year, since Varian is making 30 million in pre-tax income minus the carry forward losses minus 10 million, so the taxable income for the 4th year is 20 million. But what if Varian earns additional 5 million the first year? It will owe taxes on extra 5 million in the year 4. So basically the extra 5 million in the first year is 35 million, so the 35 millions in the tax losses will be offsetted against the first year income of that amount, and then the rest of the amount, it comes the same, except for the 4th year there's only left over $5 million to be offsetted, so that 5 million will be deducted from the pre-tax income of 30 million, so there's left over for on the 4th year 25 million. But the 5th year, since there's no more to be offsetted, so the whole amount that Varian able to accrue, able to receive or earn, so that's the whole amount that Varian has to be taxed. Therefore, when a firm has a tax loss carry forward, the tax impact of current earnings will be delayed until the carry forwards are exhausted. So you can see that all the amounts are being exhausted, only then the normalcy of the taxable income on the current earning will be resumed. This delay reduces the present value of the tax impact, and firms sometimes approximate the effect of tax loss carry forward by using lower marginal tax rate. Okay, so that's the way how the tax carry forward will be more or less being computed. Break-even level of an input is the level that causes the NPV of the investment to equal 0. HomeNet, let's look at the HomeNet IRR calculation. So if you were to look at the base case, the numbers that we churn out is, let's look at this spreadsheet. The free cash flow that is being generated is initially, the year 0 is minus 6.5 million, followed by year 1, 5.1 million, 7.2 million for the next two, for second, third, and 4th year, and the 5th year we have 2.7 million. And based on all this, our NPV at 12% required rate of return is 5.027 million, and the IRR for it is around 24.1%. If you were to look at this break-even analysis, when we find the NPV is 0. So when NPV is 0, if you were to change, so what are the variables that we can change? And also given the fact that all other variables remain the same. So in other words, if we were to change for the first one, the unit sold, we decrease to $80,300, the NPV will be close to zero. Or we can break even if we were to change the whole price and we change it to $232.42, or even the cost of goods sold, the per cost that the price that we are incurring is 137.58, or even the cost of capital to make it break even is 24.1%. Let's have a look at the next slide. How do we go about it?
For the next slide, you can look at under the tab, under the Excel tab, which is break-even analysis. So, so what we are doing is that we are trying to do what the previous slide is doing and see how the changes affect the NPV.
Let's look at this table. So what I've already done is that I've already created a table here, a smaller one, where I've got in the line items that I'm going to change are the unit sold, or the wholesale, or the sale price, and even the cost of goods sold price and the cost of capital. And also probably also I can change the net working capital and the cannibalization effect. So here are the base case. Okay, these are how we run through here, which is 100,000, wholesale 260, cost of goods sold. This is the numbers that we run through. Our assumption is going to remain more or less the same throughout the years, and the cost of capital is 12%. Okay, here is the break even. The break even numbers here indicate that if you were to break it, just replace the unit sold price, let's say 100,000 by 80,300, the figures that I'm going to have here, the NPV is going to change. So here what I did was that I split the spreadsheet into two screens here. So you got the upper portion and here is the bottom portion. So you can look at the spreadsheet, kind of awkward because it's been split. So this is the bottom half. So what we're going to do is that we're going to see the effect. Okay, if I were to change this column here, the input, if I were to change from 100,000 to 80,300, how is it going to affect the NPV? The NPV, if it shows zero, that means you say the company is just break even. Okay, so let's look how it does it. Okay, if I were to input it into 80,000, so I just kind of copy it. So you have 80,300. So the numbers here change to 0.25. Okay, let's look at other numbers if you were to change it. So we restore the 100,000 back, and the wholesale price, if we were to change from 260 to 232.42, how is it going to affect? So what we are going to do is that presumably we are decreasing the sales price to $332.42. Originally, all this base case with all the numbers intact, it will generate an NPV of around $5 million. So what is the tolerable or the decrease in prices I can work out given all the numbers remain the same? Okay, so if I were to do that, what I can do is that I can just change the numbers here, and can see that if I were to change it, decrease the price, it's just barely make it. Okay, it's just break even. Let's look at another two more numbers here. If the cost of goods sold, I can negotiate with the seller. I can say that okay, so here what it says, it's not negotiate. Let's say to what level I can tolerate in terms of the increase in the cost of goods sold, so I can just break even. So if I were to do the same thing here, just kind of copy it, 137. It's just that if I can still break even, still, you know, can break even the cost of goods sold price if the outsourcer willing to increase the price up to 137, I can just barely make it. Okay, so the next one is if I were to change it, okay, the cost of goods sold, okay, what is the cost of goods sold, the weighted average cost of goods sold? I can simply break even it. So I just change it here, 24%, so I can just barely make it. So these are the things that you can do just to kind of figure out, you know, what is, how much can you, to what extent you can change any of this variable and keeping all the variables the same, and how, to what level it can be tolerated where the company is simply break even.
Another thing is that when we look at the changes just now, when I change the cost of capital from 12% to 24.1%, and as a result, the NPV is close to zero. So basically what we are doing here is that we are finding what is the internal rate of return. The internal rate of return, as we know, definition is when NPV is zero. So that is the rate.
Have a look on how we do sensitivity analysis. Sensitivity analysis shows how the NPV varies with a change in one of the assumptions, holding the other assumptions constant. So more or less it's like a break-even analysis, but we are just looking at different scenarios, worst case, best case, and most likely case. So let's have a look at that. So in this sensitive analysis, we have a table here, and then we have like a bar, horizontal bar chart. Okay, so the way how it's being reconnected, okay, in the table, let's say we look at units sold. Okay, we have quite a number of line items here that we put up here, and then this is the initial assumption is our base case, and then worst case and the best likely case. For example, if you were to look at the units in thousands, let's say the number here 100 is represented by 100,000. If it goes by 70,000 in worst case, what will happen? So how it's being reconnected to this bar chart, horizontal ones, is that we have NPV at the horizontal line, and we have all the line items being lined up here accordingly to the one that we have in this table. So if you were to look at here, the initial assumption, which is we start with 100,000. With 100,000, we are going to have a NPV of somewhere around 5.2 million based on our previous spreadsheet. And then if worst case scenario, if it goes to 70,000, here we are going to have something around, let's say it goes to minus 2 point NPV. So what happened was that what it does is that we are running the break-even analysis as what I've shown in the previous table, and for every instances, if we were to change the numbers to, let's say, 70,000, it goes to NPV minus, let's say here, minus around 2 million. And then if the best case, it goes up to 130,000, we have NPV of around 13 million, somewhere around here. Yeah. So given, if you were to change any of this, we are assuming every of other line items remain the same. So it's like you are running all the break-even numbers, doing like what I did just now, using the break-even analysis table, but you're running the numbers differently. You're looking at the worst case and best case, and what you're doing here, you are summarizing it on the table. So if you are presenting to the top management, this is what they wanted to do. They would like to see the summarized case. They don't want to look at the whole spreadsheet, what you turn out. They would like to see, okay, how's the impact of this? What will happen if you were to change some of this variable? How is it going to affect? So if you're able to come up with this summary here and having this table, okay, with this table, it will tell you how the matching with the NPV, how it affects, then it will provide a lot of contribution in your analysis. Okay, let's look at a case study based on this scenario analysis. The problem, the current forecast of HomeNet's marketing support costs of 3 million per year during the year one to year 4. Suppose the marketing support cost may be as high as $4 million per year. What's the HomeNet's NPV in this case? So here what we are assuming that if the marketing cost increase from 3 to 4 million, how is it is going to affect the whole NPV? So the solution, we can answer these questions by changing the SG&A expenses to 4 million in spreadsheet table and computing NPV of the resulting free cash flow. We can also calculate the impact of this change as follows. As a 1 million increase in marketing and support costs will reduce EBIT by 1 million and will therefore decrease HomeNet's free cash flow by an after amount of 1 million times 1 minus 40%, which is a tax rate equals to 0.6 million per year. The present value of the decrease here is, we just run, okay, so this is the incremental effect of the increase in marketing cost is going to affect the EBIT, and the EBIT we calculate after the tax cost is going to have an impact of minus 0.6 million every year, and then we discounted it for the next 4 years by 12%. So the negative impact of it is minus 1.8 million. So HomeNet's NPV will fall from 5 million minus 1.8 million equals 3.2 million. So this is another way, very quick, short way, intuitive way of how to figure out the incremental negative impact. Or we can just simply run the spreadsheet all over again and just replace the 3 million to 4 million and see what's the bottom effect on the NPV, and the NPV will also show a reduction but to $3.2 million from $5 million. Okay,
so that's the end for today's lecture. So hopefully everybody able to understand, and this chapter is quite long, it's very important, so make sure you understand the essential part, what I've already explained, all those vital parts, and I will post up the question later on. Okay, thank you.